I'm sure, just as we all were, I was kind of surprised and excited this morning when I saw that China was cutting its triple R. What do you think? We haven't seen much impact, I would say, in markets around the world. What do you think this means for markets going forward?
I think it's not for me a really game-changing move. We've seen them sort of cutting reserve requirements over the last 12, 18 months, and so I think this is more of the same as they try to sort of, in a sense, free up their banking system from the constraints it's operated under historically. I think for me, what I would really get more excited about would be a commitment to more fiscal spending, actually, because I think that would have a greater impact on the Chinese economy near term than another cut in reserve requirements. Well, speaking of stimulus, maybe the other really exciting piece of news we got today, obviously to the downside, was euro area inflation, with the headline number back below the zero bound and the core number missing estimates by a lot at 0.7%. Do you think this sets us up for some real stimulative action from the ECB in 2 weeks' time? I'm convinced the ECB will definitely go and come and do something. It'll probably be either a further cut of the deposit rate further into negative territory, maybe a QE extension. But I have to say, I'm not convinced that will actually be a particularly effective remedy. We've seen the impact of moving to negative rates earlier this year in Japan. Actually, that ended up probably having the opposite outcome to what the policymakers wanted. And my fear is that pushing the rates more negative here in Europe will actually be relatively toxic for the European banking system rather than supportive. So I think it will happen, but I'm not convinced it should happen.
Your quote of the day, kryptonite to bank shares. I love that. Love that. I mean, is it time to be buying banks in the euro area? Andy, despite what you've just said, despite the fact we might be seeing further moves into negative interest rate territory just because of the declines we've seen in the last 3 months?
I think to go and buy, let's say, the broad bank index, probably not. But I think there are some countries where the banks are probably safer than others. So, for example, up in Scandinavia,
Swedbank's increasing its mortgage rates, isn't it? We've got a lovely story today saying which banks benefit from negative rates, and some do, don't they? They're able to boost their margins by tweaking various. So if you're in a market which will allow you to push up the mortgage rates, loan rates, and so on, then you can kind of offset the damage that a negative rate does on the liability margin. But in a sense, that's completely counterproductive to what policymakers want to happen. Back in the good old days when we had positive interest rates and things made sense, you cut your policy rate and mortgage rates came down with that, and then people had a bit more money to spend, and the economy hopefully picked up speed. But we're now in a kind of Alice through the looking glass world where nothing is really quite as it seems, and I think my fear now is the banks start actually seeing margins come down. They generate less profit, less capital, and that just acts as a real headwind to any kind of growth. Let's talk Brexit, Andy. Stocks are rising since the referendum was called. We know what's happened to sterling. It's down to its lowest level against the dollar since 2009. Is risk of the UK leaving the EU priced in to the UK stock market? Because many are looking at the mid-cap, the small caps, as possibly the ones that could be hurt the most by a Brexit, as it's called.
I think if the UK ends up deciding to leave, that probably isn't priced into the stock market yet, because if you look at the polls, if you look at the spread betting firms where people are actually putting their own real money rather than simply answering a question when a pollster phones them up, that all at the moment is still inclining very much towards a decision to remain. In the event the polls move and we start seeing a majority for exit, I think that will be cause sterling to weaken, and will also be negative for the UK small and mid caps because, particularly in the mid cap arena, there you do tend to have quite a lot of trade with the eurozone. Yeah, for the very small caps, actually they're probably quite domestic, and so that's not so much of a problem. But so the mega caps, the FTSE 100, they're global companies.
Yeah.
Brexit kind of doesn't really matter.
Yeah.
The very small caps, they're domestic. Again, Brexit probably doesn't matter.
But
it's the mid caps is where I think we'll see the biggest impact if and when it
materialises
happens.
on the 23rd of June.